Good afternoon, everybody, and welcome to Rich TV. Today, it's a pleasure to be speaking with Richard Bolwjin, the head of investment research, investment and enterprise division at UNCTAD. And Richard is the team leader of the Africa component of UNCTAD's annual World Investment Report. Richard, thanks for making the time today.
You're most welcome. Pleasure to be speaking in this occasion on FDI trends, on the occasion of the launch of our 2020 World Investment Report. This is an annual report that UNCTAD, the United Nations Conference on Trade and Development, brings out every year. It contains a section on the latest trends at the global level on foreign direct investment, and it discusses the prospects of foreign direct investment. It discusses investment policies and policy measures taken over the past year, and it always contains a theme chapter which is aimed at a specific topic related to foreign direct investment, international trade, international production. I'm the head of investment research in UNCTAD, and I'm very happy this report is now out this year, despite the difficult circumstances that we find ourselves in, of course, worldwide. The report this year projects for 2020 a 40% decline in global foreign direct investment flows.
That must be one of the biggest declines ever, I would have thought. I mean, has there been a similar decline in the last, 50 years? What happened, for example, at the GFC or at previous crises that we've had? Is this the biggest decline on record, or?
It could be. The total decline after the global financial crisis was at the maximum point about 35%. Yes. So I think you're right. This is probably the biggest decline we have seen, at least in my memory. After the global financial crisis, it actually took about 2 years for that decline to materialize. Foreign direct investment is actually quite sticky. Investment projects take quite a while to materialize, to be rolled out. Investment decisions are not generally reversed that quickly. So it took a while for that to happen. And that was the result, because at the end of the global financial crisis, most of the decline in foreign direct investment was the demand shock, right? It was the recession that caused a big drop in global investment. This time around, it's different. We have a combination of factors. So the negative effect on global foreign direct investment is immediate, because, well, there's first simply the shock caused by the fact that people cannot physically reach their places of work. Construction sites for new projects are closed or have been closed for a certain period. So there's been a supply shock in addition to the demand shock. And as a result of that, the effect, the 40% drop is immediately projected for this year. But in reality, we project a further fall next year, exactly because of that reason, that foreign direct investment reacts with a time lag to recessions. So our projections do not show an uptick, a recovery until 2022.
So you're not subscribing to this V-shaped recovery. You're saying actually this is going to, one, that it's been a hard stop is what I'm getting from you, and then secondly, it's going to be more prolonged than many.
Yes, I'm afraid that's true. At best, what we see is a U-shaped recovery, but the longer term trend is also affected by a number of negative impacts that are partly related to the COVID-19 crisis, but also partly the result of simply longer term trends that were already taking effect even in the past few years. So the COVID-19 crisis has longer-term effects because of policy changes as a result of the crisis. Right, we were already in a trade war, and the COVID-19 crisis has triggered further policy measures, especially among developed countries, to increase investment screening, to have more scrutiny of inward investment flows and inward mergers and acquisitions. But there's also the longer-term trend of increased demand for supply chain resilience and increased pressure from both the public and policymakers to avoid being too reliant on what we call factory Asia in critical supplies, medical equipment, pharmaceuticals. But in reality, this trend might actually expand beyond those type of critical supplies related specifically to medical events, and move towards broader industrial production. It's becoming less and less acceptable for policymakers in other regions around the world to be so reliant on factory Asia to produce key components. We've seen a lot of stoppages and production interruptions in North America, in Europe, because certain components were not available for a certain period of time, and that's causing a lot more scrutiny now to the type of investment patterns that we have seen over the past few decades.
Excellent, interesting. Richard, when I was looking specifically at the Africa report, what I noticed was we were already seeing a slowdown in FDI. The trend was already signaling to me, obviously more intense in certain areas. West Africa, I think, was already shown. Can you give us a perspective? Is that correct, that there was already some kind of slowdown going on, and then this has now been a kind of circuit breaker, or how would you characterize the Africa story?
Yeah, this is, there was already a decline last year in foreign direct investment flows to Africa of 10%, right? A 10% decline for the continent as a whole. And again, that was part of a longer-term trend that we have already documented over the past 10 years. We showed in the past few editions of our World Investment Report that especially greenfield investment, so the most useful type of investment in new facilities, new factories, in manufacturing, was on a longer term structural decline. So the new greenfield investment projects over the past 5 years have been significantly lower than the 5-year period before that. So there are a number of trends that we registered, including in Africa, but actually this is part of a wider global trend of more what we call asset-light investments, so more intangibles in foreign direct investment flows. I already mentioned the trade war, and this is there's clearly a global policy environment for trade and investment that was much less favorable over the past 5 years than it was in the period before. So technology trends are driving this, right? We of course see coming. Everyone is talking about the new industrial revolution, about Industry 4.0. It goes by different names, the digital economy. All of this is leading to opportunities for investors, for multinational enterprises to take another look at their global investment production, international production networks, and reassess whether going for investment drivers like low-cost labor is still as favorable, as attractive as it was before. So this trend that we registered over the past decade of stagnating investment flows was already there. COVID-19 could be an accelerator of that trend. At the same time, what we see is that there's an immediate shock now that really accelerates that downward trend. But there are longer term still opportunities to be had for developing countries, for African countries, to also to continue to attract investment However, that does require a new look at investment promotion strategies, at industrialization strategies that are dependent on foreign direct investment.
Can I just ask you a couple of questions on that point? You know, the theory was that as China became much richer, there was an opportunity to take a lot of this low-cost manufacturing onto the African continent. And in many respects, I suppose the Ethiopian model is a little bit trying to take advantage of that. Are you telling us that that model is not really delivering the results one would have hoped for? Is that what you're saying, that the world has moved on, as it were, and become more complex, and therefore, you know, that idea of low-cost labor, doing what Asia did 30 years ago is not going to work? Is that what you're telling me?
Well, there is a fear of this happening, right? I mean, over the past few decades, you know, international production driven by foreign direct investment has grown very rapidly. But as I said, it already slowed down in the last period. In the 90s, foreign direct investment grew by an average of 20% per year. In the 2000s, by only 20% per year. In the 2000s, by less than 10%, and in the 2010s, by less than 1%.
Wow.
So this is already something that, you know, we could see this coming, right? And this COVID-19 shock is really bringing the message home, right? Now, what we're seeing is that the model of development based on integration in global value chains and global supply chains, based on industrialization driven by foreign direct investment in manufacturing industries, based on focusing on specific, what we call tasks, segments of global value chains, which is a development message that multinational organizations, including UNCTAD, we've tried to bring this out for many years as an opportunity to develop. But what we are seeing, and what we have seen already over the past few years, but what is really now coming home, is that the global pool of foreign direct investment flows in that type of activity is a shrinking pool, right? So that doesn't mean that the opportunity is foregone completely. There is still opportunities there to be had. There is, of course, a shift from China and countries which have you know, increasing wage levels where the cost of labor is no longer such an enormous advantage to other countries. So there is still some of this taking place. Even during the trade war, we see some trade diversion taking place, mostly to other countries in the Asian region.
Yeah.
But there are opportunities to capture benefits from trade and investment diversion. However, the overall pool of that type of investment is not growing at all. And what we're seeing, we reported last year in our World Investment Report that specifically spoke about special economic zones, right? Yeah. Free zones. The number of such zones around the world is ballooning, right? We've seen that there are now more than 5,500 of such zones around the world, growing from less than 4,000 only 5 years ago, right? And there are still hundreds of these zones in the pipeline at this moment, right? So people are, governments around the world are competing more and more strongly to attract foreign direct investment, that shrinking pool of foreign direct investment. So you can see the two trends colliding, right? So we see an enormous amount of new special economic zones popping up in a shrinking pool of foreign direct investment, meaning that the incentives and the advantages that need to be offered to foreign investors in such zones need to become ever more attractive, meaning such zones become ever more costly. So what we are saying is that you really need to be well aware of this trend and not over-invest in expensive and sophisticated facilities that have the potential to become a real big cost on the books of nations. We really need to look at the return on investment on those type of zones.
So let me just now go to your actual report and just ask you to tell us, you know, I looked through it and it seemed to me what stood out to me was Egypt was a very big success. in an environment where investments were going down, they actually were attracting a lot more. Can you just give us a picture on the continent? I was surprised at Ethiopia, for example. That model seemed to not be attracting as much money as it was. What's the overall picture if you took us for a tour around the continent? What would you be telling us?
Yes, I mentioned already the overall picture for the continent last year was a 10% decline in foreign direct investment flows. However, the decline in the number of new greenfield projects, which I tend to look at more closely, right? Because that's the real investment that really helps industrialization. And that decline was not as strong as the minus 10% suggests. Still, it was about minus 3%. But the overall picture is, for most of sub-Saharan Africa, the largest economies that attract most investment most years were all on a negative trend last year, right? You mentioned Egypt already. That was the one exception. Egypt is the largest recipient on the continent. They received, they had an increase last year. But in most countries on the continent, the negative flows were quite severe. Looking at the prospects for this year, because clearly last year's trend with the major developments that we're seeing this year as a result of COVID and as a result of the enormous decline in commodity prices, is going to dwarf whatever effects happened in 2019. So we focused mostly on prospects. And what we're seeing is that, of course, what are the industries and the countries that will be impacted most? Well, one, we have, of course, an enormous impact this year on services, leisure, travel. So all those countries that are really pushing to attract tourism investment, that are building tourism facilities, this year is a very bad year to attract investment. And that type of investment overall accounts for about 10% of flows.
Wow.
So that's an important element. It is not as big, of course, as manufacturing investment or as natural resources investment, but 10% is a goodly number.
And they're probably people dependent on tourism.
Absolutely. Both in terms of employment and income generation, but also in terms of foreign exchange generation and services exports. So this is important.
On tourism, when are you, I know it's a very difficult thing to predict, but when do you predict that service sector will start rebounding? Because, you know, I keep watching around the continent and you get these announcements, you know, the flights will start in August or September. And it seems to me it's more about behavioral economics. Who's going to get on a flight at this point in time with this level of uncertainty? So I don't know. How do you forecast the rebound of the service sector? Are you optimistic, or do you think it's going to take longer for people to start getting back to those levels we saw?
Yeah. I'm not an expert on this, so I can only talk by what is my intuition on this. I mean, the very fact, the way we are talking now remotely on video conference, I've been doing quite a lot of this over the past 3 months, as everyone around the world. And my feeling is that this could well last quite a bit longer.
Yeah.
I cannot really say much about how long it will take for the services sector to rebound, but you know, our expertise is in the area of investment, and certainly the current capacity, because what investment does is to create capacity, productive capacity. The current capacity can well be seen as an overcapacity at this moment with this level of demand. So even if the services sector picks up, hopefully, and to safeguard the economic impact, the income generation of the sector, the investment will certainly not pick up with the same speed, because there's at this moment no need to generate further capacity with the current demand levels. So just looking from an investment perspective, I look at this quite somberly.
Yes.
Of looking at the rest of the continent, the rest of the sectors, I mean, of course, we know that for foreign direct investment and for exports, Africa is quite dependent on natural resources, and that's of course where the biggest impact is.
Yep.
If we look at one of the barometers that we use is looking at the behavior of the top 100 and the top 5,000 multinational enterprises. Top 5,000 multinational enterprises around the world account for almost all foreign direct investment in actual greenfield projects. And they have seen on average earnings revisions of more than 40% over this year alone, right? Big declines in capital expenditures expected. And if you look at this, the natural resources sector specifically, the effect is much greater there. I mean, there's basically a complete stop, and this is it's going to have a big impact on inflows to Africa.
Are you
And the
seeing
last one,
across, like, I mean, if you look at big projects in the extractive sector, you've got Mozambique, that gas project, which is enormous. Would you forecast a slowdown in something like that? And the other point is the oil sector, of which, Nigeria, Angola, and a number of other countries are so dependent. At this sort of price, I know we've rebounded, but it strikes me that people are going to be doing multi-billion-dollar investments unless they see a higher price structure. Do you agree with that?
Absolutely. I mean, our forecasting model for foreign direct investment takes price changes in commodities, in oil prices, and it causes a big drop, and that's obvious. If the return on any investment depends on the type of prices you can get for the resulting commodities. Now, of course, in investment projects in natural resources are very long-term projects. So that means that the investments they're not cancelled immediately. Projects do go on, but they are clearly slowed down. You don't need to bring online new production in this particular period. So what people tend to do is just slow down the implementation of projects. That's why we see an immediate effect on the flows this year, but it will also show an immediate effect on the starting of new projects, clearly. Then moving on to where's the next big impact. I already mentioned the type of GVC intensive industries, right? Global value chain intensive industries. One of the biggest effects is on automotive, so that's we see huge amounts of earnings drops there in the multinational enterprises and a slowdown in new projects. But it goes across the board for what I call GVC intensive projects. And unfortunately, that's exactly the type of manufacturing greenfield investment that we're trying to attract in special economic zones for industrial development. So, if looking at these three sectors, so the services sector, looking at natural resources, and looking at GVC intensive manufacturing, those are things that those are the clients that we foresee will have a big impact on flows to Africa. This is also because of the dependence on that type of investment. This is also precisely why we can expect a bigger decline overall in the developing world than in the developed world, right? Where investment is going to different sectors as well, and where investment flows also contain large amounts of different types of financial flows, financial sector flows, so that they tend to be more less affected by the COVID-19 crisis at this particular moment.
And then can I just finally just ask you, what are your policy prescriptions in this environment, which is obviously significantly tougher? And from your report, you're seeing a lot of weakness that was already unfolding, particularly with models that a lot of African countries have been following. And you're kind of telling me things are changing quite dramatically. What are you prescribing right now? I know, it's a continent of many different countries with different advantages, but overall, I mean, what are you saying as UNCTAD to countries in Africa?
Well, we're looking mostly at that longer term perspective in order to come up with our policy picture, right? So the COVID-19 crisis now is an immediate crisis for this year and for next year. And it is very hard to, beyond what we're already doing, to come up with policy prescriptions. I mentioned already, we expect a strong impact on the developing world, on African countries, not just because of the sectoral composition of their investment portfolio, but also simply because they haven't got the wherewithal to put in place the same types of economic support measures that developed countries might be putting in place. So we expect an immediate strong impact, but the policy prescriptions that we talk about most are more aimed at the longer term picture that I painted before, where we see this shrinking pool of FDI in physical productive assets in the manufacturing sector. And I say physical because we do see a continued growth in the type of asset light, intangible type investment, but that's not the type we're looking for industrial development, right? Now, so what does this mean? One of the policy recommendations I mentioned earlier already, just in passing, which is that the type of big infrastructure that we are building in special economic zones, with facilities all pre-built for investors, with perhaps big infrastructure investments to make it as attractive as possible for foreign direct investment. We really have to make sure that we look at the return on investment of those type of investments, and if they can be made in a sort of gradual manner, where we are careful to make sure that we do not overinvest, but invest year by year based on what kind of success rates we have, to make sure we don't plunge into to make sure that the fiscal and the economic picture of those type of big infrastructure investment is sustainable. That's really an important part of the.
Are you worried about the sustainability of some of these big infrastructure projects that have been done over the continent, like the railways? And I mean, it strikes me these were built for a go-go growth phase, and if we're not going to get that, they're going to have a negative return on investment.
Well, I don't want to put all infrastructure investment into one big bucket, right? What I'm talking about here is the type of infrastructure specifically built to attract foreign investment in manufacturing. In reality, what we're saying is that before we had industrial development models that were purely based on exports in a global value chain participation type model, right? What we're going to now is we are not going to throw that away, because that remains an important part of the development picture. But in addition to that, we need other things too. We need to make sure that our investment promotion agencies get a bigger, try and broaden their targeting towards investment in, precisely as you're saying, infrastructure for domestic growth, right? Infrastructure for domestic industrial development, and in domestic services. And those are typically the type of services that, well, in the UN we call investment in projects that are that support what we, our sustainable development goals, right? So we're talking about power generation, renewable energy, water and sanitation, education, health. Those are the type of investments that where these were previously mostly domestic services industries. There is now increasing interest from international investors to put money into those type of domestic services and infrastructure sectors. So while we're seeing a shrinking pool of investment in manufacturing, and that is damaging for industrial development prospects, there is a compensating mechanism for international investors to become more interested in domestic services and infrastructure. But that does mean that, so we're saying we're going from export, purely export-oriented investment promotion, to export plus plus. So yes, we keep export in a targeting, but we also want to promote investment in other sectors. We're going from investment promotion through the provision of big infrastructure in a towards a much more lean model, right? A lean infrastructure model, where we're really careful to make sure that the economic and fiscal picture of infrastructure built specifically to attract investment remains sustainable.
It's been a pleasure, Richard, speaking with you today, and I'm really grateful that you made the time. And I look forward to having further discussions with you about this really important subject. If I can just ask you to wrap things up in a minute or two, are you, you're painting the sort of L-shaped situation through this year and next year. But are you, if you look beyond that, are you reasonably optimistic about the prospects for the African continent?
Yes. Looking beyond that, we have to realize that we are now going through a big shock at this moment, but we see that total flows worldwide are going to get a big hit this year. Still, they're going to add to an enormous foreign direct investment stock, about 36 trillion at this moment. And so international production will remain important, even looking ahead. And they will remain an important lever for development and for industrialization. Now, the African continent is, the participation of the African continent in this international production picture is still far too low. It's less than 3% of global foreign direct investment flows, at the 45 billion around there that the African continent receives on an annual basis is still only a small part of the total. But despite the immediate shock now and the slow recovery and the recovery in a different through a different modality of international production in the decade to 2030 going forward, still brings new opportunities. They just need from investment policymakers, investment authorities, investment promotion agencies on the continent, a reassessment of what to target and what kind of infrastructure packages and incentives packages and policy packages to put in place to continue to attract investment. The emphasis now is less on purely low labor cost based exports in small segments of global value chains, small manufacturing segments of global value chains, towards broader based industrial development, towards development based on investment in domestic services and domestic infrastructure. And there is a lot of capital available right now, and there has been for a few years, with such low financing costs worldwide, a lot of capital looking for investment opportunities in those areas.
Richard, we shall have a conversation about that opportunity the next time we speak. I'm really grateful for you to make the time, especially early in your morning. And thank you very much for giving us such a great view as to how things sit. Thank you so much.
My pleasure.
Thank you, Richard. Great. Thank you.